here at the Oncology Institute. I've been with the organization about 6 years, 3 years as CEO. I'm a physician by background and have spent the last 14 years in value-based care. Really excited to tell you our story today. Before we get started, I'd also like to introduce our CFO. Rob, would you like to introduce yourself?
Yeah, happy to. Good morning, everyone. Pleasure to be here with you. I'm Rob Carter, CFO here at the Oncology Institute. Been at the org about 4 years now, about a full year as CFO. My career has been spent either in managed care or in pharma finance, and so TOI is a great place for my background and skill set. Looking forward to walking through the company with you. Back to you, Dan.
Great. So I will start the presentation today with a high-level overview of the Oncology Institute, who we are, what we do, and why it's so valuable to healthcare in general right now. And then we'll spend a little bit more time talking through our financials and open it up to Q&A. So if we go to the next slide, please, Rob. Great. So just to set the backdrop, oncology care is a significant portion of spend for the U.S. healthcare system. It's an industry that spends over $200 billion a year. The really unfortunate thing is that it's been growing at a kind of an unsustainable cost trend for the last 16 plus years. The major driver of that unsustainable growth trend is oncology drug costs. Those rise typically high single to low double digits each year in terms of the market basket cost increase, which is a huge problem for both patients who bear out-of-pocket costs that oftentimes they can't pay, which delays care or doesn't allow them to get appropriate care, and for payers, meaning health plans who have an unsustainable trend in specialty costs related to oncology. So what does that mean? It means that there's a huge need in the US for an entity that can provide clinically excellent care in the community to underserved populations and bend the cost curve to provide better access for patients and more affordability for payers. We go to the next slide, please, Rob. So who is the Oncology Institute? We've been a public company now for almost 4 years, but we've been in business for the last 18 years. We are the largest value-based oncology care provider in the country. When I say care provider, we are both an employed physician group. We employ physicians in medical and radiation oncology sites of care across 80 locations and 5 states. And then we have engaged MSO or contracted independent community medical and radiation oncologists that also help deliver care underneath our capitated contracts. We are the largest in the country as measured by patients that we take risk on for Part B as in boy. That's the oncology-related spend on physician services, and Part B or infeasible medications. We've got over 2 million patients at a population level that we take risk on Part B for, and that's across product types: Medicare Advantage, commercial HMO, and managed Medicaid. Really, our mission is pretty simple. It's to bring cutting-edge care into the community to underserved populations, shift out of high-cost centers of care, and really elevate the level of community-based oncology care. The great news in terms of doing that while also reducing spend is that there's a tremendous amount of overutilization in oncology related to using medications off-label, off-pathway, overuse of supportive medications, all of which drives up spend. So just by doing 100% NCCN compliant appropriate care and delivering it in a lower cost setting, you can dramatically bend the cost curve. And we've been showing that we can do that for the last 18 years in published results. As you can see, we partner with most of the major health plans and large-scale risk-bearing medical groups in the country. This is not an exhaustive list on the bottom of the slide. But we've been partnering with them for the last 18 years. Many of our contracts go back over 15 years, and we've got very low turnover in our partnerships, which I think is a testament to the quality of care we provide and the savings that we can generate. Go to the next slide, please. So it's important to understand how the Oncology Institute is unique in the space and really how differentiated we are in terms of our competitive advantage. If you look at the sort of landscape of lookalikes in oncology that provide value-based services, you've got the what we call benefits managers, and really the public company example of that would be Evolent, which has New Century Health. There's also some private companies like OncoHealth and OPN. Really what they do not employ physicians. They take capitated risk like us, and they provide utilization management services over a network that's 100% independent community-based practices and academic centers. There is value in those services, but at the end of the day, they're providing utilization management to practices, which oftentimes have misaligned financial incentives to the recommendations that they're making. So there's kind of limited cost savings and cost curve bending that can occur in that type of setting. You've got some of the newer, larger total cost of care navigation models like a time care. We've seen similar platforms in the kidney care space for many years with Monogram and Panoramic. They're more frictionless. They do a lot more care navigation. And at least what we've seen in the kidney care space is that there is some savings to be generated there, but it's relatively modest. We're differentiated in the sense that we have employed assets in all of the markets where we provide care. That's our employed clinicians and clinics, both medical and radiation oncology, as well as WRAP, MSO, independent providers. What that means is that we've got a much higher degree of control over care delivery, meaning higher compliance to value-based prescribing, better ability to deliver ancillary services like clinical trials and transfusions in our employed centers, all while also having engaged independents, which is desirable from a health plan perspective. So we're able to contract at more competitive rates, and we generate a more predictable cost savings in terms of the MLR that we're able to generate and track on our risk-bearing contracts. Again, this slide pretty much covers what I just mentioned. We're solidly unique in the space in terms of our differentiated ability to provide cost savings for payers and patients. On the left side are, again, Evolent, that's New Century Health. That's kind of the public comparable. You also have OPN and Time Care. On the right side, that's really the other set of assets that exist in oncology. And this is sort of the problem against which TOI fights, if you will. These are the fee-for-service aggregators. So think OneOncology, Aon, US Oncology. They really aggregate density in a market through contractual relationships with independent groups. They drive up rates in utilization and drive up drug spend. So they're generating the high benchmark spend and overutilization against which we're able to capitate. We really provide a full suite of services and are differentiated in our ability to deliver high-level care in the community to underserved populations. If you look at your average community-based oncology practice outside of the academic or tertiary setting, typically they're relatively limited in terms of the services that they can provide. We are full spectrum in the sense that we bring clinical trials to the community. That's actually very important in the sense that we have a large percentage of our patients that are non-English speaking or from demographics that are economically underserved. And data shows that those populations typically have difficulty with access to clinical trials. That makes us very attractive to clinical trial sponsors because we do have access to those populations. And it's important for those populations in that they can actually get enrolled in clinical trials that they might not typically have access to. We provide outpatient blood transfusions at scale. That keeps patients out of the emergency room, out of the hospital. Again, another tool to bend the cost curve. We provide 100% NCCN compliant. That's the gold standard in oncology prescribing through our proprietary utilization management pathways, which are overseen by our clinical leaders and developed and updated kind of real time as new drugs are approved for use. And we provide highly coordinated care in terms of partnering with hospice and palliative care providers that our health plans and medical group partners are aligned with, having appropriate advanced care planning discussions. We're also an NCQA certified patient safety organization and track a number of KPIs at scale related to outcomes, patient experience, and quality of care. And we've studied and published on our model multiple times. We actually presented this last year at ASCO. Again, ASCO is the largest clinical oncology conference in the world. It occurs each year in June in Chicago. We presented again on outcomes of our model versus standard of care as it relates to clinical outcomes, patient satisfaction, utilization, and cost savings, and have shown again that we are differentially better at bending the cost curve and driving overall cost savings and reduction in spend while delivering higher patient satisfaction. This just goes over our current scale. This is important for a couple of reasons. One, in terms of understanding our P&L, which Rob will go into in more detail. TOI currently exists in 5 states. As I mentioned, we've been around for 18 years. 15 out of those 18 years were exclusively in California until we went public. And then we made a big bet on new market expansion where we saw areas of heavy Medicare Advantage penetration and opportunity to capitate. That means expansion in Florida, Nevada, Arizona, and adding additional sites of care in California. In 21 through 22, that led to a lot of CapEx, a lot of spend, which dipped us for the first time to negative EBITDA territory. When I became CEO 2.5 years ago, we restructured our company, took about $11 million of SG&A out of the business, figured out product market fit outside of California. And as we've talked about in our prior several earnings calls, have had record success in terms of signing new capitated partnerships in our expansion markets. We already have the cost structure set up in those markets to deliver care, and we have capacity, meaning as we add new value-based partnerships, it's highly accretive to our P&L. And that's why we've projected flipping to adjusted EBITDA, break even, and profitability in Q4. What this slide also shows is that there's a huge percentage of the map where TOI does not deliver care. There's tremendous runway to continue to grow this company to a multi-billion-dollar platform in upcoming years. And we get constant outreach from payers in markets across the country where we don't exist to expand our model. So while we've been laser focused on, again, filling capacity in our existing 5 markets as we generate profitability as a public company, there's many, many years of growth ahead of us in terms of white space for the company. Go to the next slide, please. So with that, I'm going to pivot over to Rob for just a high-level overview of our financials, and then we can open it up to Q&A. Rob?
Thanks, Dan. This is a view of the history. TOI is not new. We started as a physician-founded company back in 2007, and you can see that the top line has grown quite nicely over the past 18 years, now at a 41% revenue CAGR. As Dan mentioned, we made a large bet in Florida. We added G&A to the business by going public, and so what was a profitable business became unprofitable. And so a lot of the story this year is how TOI is going from an unprofitable place to profitable. And as Dan mentioned, guiding towards a adjusted EBITDA break even in Q4 of this year. There are 3 main drivers of that path to profitability. So I'm going to walk you through these right now. And these have to do with our segments and the way in which we disclose our financials, which we'll get to on another slide. But these are the 3 main drivers. So the first is our value-based contracts. This is our capitated segment. And as you can see, we have a robust pipeline. The contracts mentioned here went live in the second half of 2024 and then have launched in the first half of 2025. So you can see $36 million in incremental revenue from these deals. Annualized, almost $50 million. The difference between those 2 numbers is simply when the contracts launch, and there's a ramp associated with these contracts, which we can get into a little bit later. But tremendous momentum with our value-based contracts. The second piece is our growth in the dispensary segment. This is Part D, or oral drugs. TOI historically is, I'm getting some feedback. I'll keep going. TOI has historically dispensed Part D drugs through dispensaries or medically integrated dispensaries. We launched a pharmacy in California in late 2023. That led to 70% year-over-year growth, and the pace hasn't slowed. And so we continue to see rapid expansion in our attachment of Part D drugs. And then finally is our clinical productivity. And so Dan mentioned before that because we have established clinics and we have providers in our growing markets like Florida, as we add new contracts and as volume increases in those clinics, there's no additional overhead. And so the impact on the P&L is quite significant. As you can see, both the clinical payroll as an absolute dollar have gone down, but the payroll per visit has gone down dramatically. And so this sits above the line, and so it's a huge lever for us in terms of our overall gross margin. So these 3 things are what's taking the business. We lost almost $36 million last year to guiding towards, again, adjusted EBITDA break even in Q4. So let me go a little bit into detail on the segments. So we break it out into patient services, dispensary, and then other. So patient services for us includes medical and radiation oncology, or Part B. And so there's 2 main segments here, fee for service and cap. And fee for service, as the name implies, this segment is growing with the organic oncology market, so around 10% per year. It's growing quicker than that in newer markets for sure. But in terms of how we see growth in the future, it's around that 10% mark. The margin contribution is relatively low. This is reimbursed at a cost plus, and the exact number is ASP plus 6, and so the margin is around 6% on those drugs. Our cap business, as mentioned, is where the significant growth is coming. Although only 17% of revenue mix, it's the highest contributor to gross profit. The pipeline is incredibly robust, and the margin contribution is quite high. Drug dispensing, as I mentioned, this is Part D. This is now 52% of the revenue mix. It continues to grow rapidly. It will continue to grow rapidly as we grow both cap contracts as well as fee for service. The attachment, as I mentioned before, follows that growth. And margin on Part D is around 18% at this point, and so a nice contributor to overall margin. Clinical trials and other for us combined is about 2% of revenue. Clinical trials is fantastic from the perspective of getting patients the option. It also takes a patient off of a capitated drug, right? So the cost for that drug isn't being incurred by TOI as we're at risk for it. Our other revenue segment includes management fees and data monetization as well as quality programs. And so there's no COGS associated with this segment, so directly to the bottom line. So that is the segment view. This is a super important slide as it relates to how TOI is growing. So capitated contracts are paid via a PMPM, per member per month, which is a sort of a fixed fee for us taking risk on and taking care of oncology patients. That PMPM, if you look at the first quarter of 2024, averaged $3 at TOI for the contracts that launched in that period. That's a very California-based PMPM. California is a heavily managed market. It's been doing value-based care for decades. And so the cost of care is much lower in those markets. As we move to Florida and other markets that are new to value-based care, the benchmark spend or the benchmark cost to treat patients is much higher. And so that equates to a higher PMPM for us. And so as you can see in more recent quarters, the PMPM on deals we're doing is significantly higher. So this is an important lever for us because we don't need 250,000 lives at $6 PMPM to say, to have the same impact as a much lower lives count at a much higher PMPM. And then finally, super important slide here. This is our actual ability to lower the cost trend. And so this is measured as MLR, medical loss ratio. And so you can see this is a number of 6 new contracts actually that launched, and this is the real experience over the first year, starting above 70%, and then after a year in our system, around 50%. And so that's the real savings that's being driven by our pathways, by our protocols, and that's the savings that really drives the growth with providers going forward. Okay.
Great. So just to kind of wrap it up, again, major points of the presentation today are one, you should be aware that oncology care is a significant portion of our U.S. healthcare spend. There is, like any specialty in medicine, a misalignment of incentives. Unfortunately, in oncology, that's a misalignment that's driving 90% of the spend, which is around drugs, and creating an unsustainable trajectory for patients and payers. 2, there's solutions. There's been solutions to this for the last 10 years, although they've been relatively limited in terms of their efficacy. TOI is differentiated in terms of its ability to deliver, savings to both patients and payers, and has a track record of showing that we can do this across markets. We are really the best model available right now, again, for both patients and payers in terms of delivering high quality care at lower cost. We've got a proprietary platform that allows us to do so at scale. And we've shown we can do it now in 5 states and growing. So that positions us well as we transition to profitability as a public company in the upcoming quarters to continue to grow successfully, continue to drive margin and scale across the country. Happy to open it up now to Q&A, Robert.
Great. Thank you very much. That was a great overview and lots of financial information. And in the presentation, you talked about some of the benefits for the insurance company clients and third-party payers, as well as the services you're providing to the practices. There was just a brief mention of the benefits for the patient. Could you just expand a little bit on patient satisfaction and outcomes?
Yeah, absolutely. Broadly speaking, if you look at the data for oncology care across the U.S., and this is published on cancer.gov and a number of other sources, there's tremendous data on the financial toxicity of cancer care to patients, specifically the out-of-pocket spend, which can be quite high if you have cancer and need to initiate therapy, oftentimes in the thousands. For the vast majority of our country, that is an amount that requires significant savings, oftentimes tapping to long-term savings, delaying start of care, which is very concerning when you've got cancer, and also oftentimes going into financial instability. So it's a real problem across the U.S. We track data internally in terms of our ability to lower the out-of-pocket spend for patients on both Part B and Part D medications, provide better financial assistance to patients. We measure our savings on Part D in terms of out-of-pocket spend each year, and that well over $1 million a year, and on a per patient basis is very significant. In terms of patient satisfaction, we measure that with Press Ganey methodology. Again, we do that across thousands and thousands of visits a year via text and email, and have shown high levels of patient satisfaction in our model. As I mentioned, we are also an NCQA certified patient safety organization and track a number of KPIs that are specific to oncology on clinical outcomes, again, showing the safety of our model and our ability to deliver high-level care in the community.
Well, that's great. It sounds like you have the payers, the doctors, and the patients all benefiting from your methodology and the way you're running these practices.
That's right.
Okay, and just in the moment or two we have left, it looks as if you're concentrated in several markets, and you mentioned getting contacted about entering new markets. Could you just discuss a little bit about your plans for entering new territories?
Absolutely. As we've talked about on our last few earnings calls, the pipeline for growth in the markets where we currently operate are incredibly robust. In terms of return on equity for investors, the most accretive opportunities for us right now are where we actually have a footprint and we've got capacity. So we've been heads down focused on signing deals in our 5 existing markets, with a particular focus on Florida and Nevada in the last few quarters. That's where we're seeing incredibly high benchmark utilization. So that's the utilization that we measure and then capitate against. So it provides, on a PM basis, significantly increased opportunity to drive value for the company and for investors in those markets where we have capacity and there's high utilization. We'll continue to do that in the upcoming quarters. We've been approached about opportunities in other markets. Again, if we've got something that's sizable enough where we can project near-term, elimination of cash burn and profitability within a year, which there are those opportunities out there, then we'll take those seriously. But we haven't been super aggressive about just putting dots on the map in new markets until we fill capacity in our existing footprint.
Great. That sounds like a very well thought out plan for growth. Okay, I'd like to thank you for this presentation and look forward to following your progress in the coming quarters.
Thank you so much. Appreciate the opportunity.
Thank you. Take care.